Who doesn't like to invest in small cap funds? Especially at a time when small cap funds are delivering significantly higher than the Nifty 50, which is the large cap bellwether index, right? But in recent weeks, there is a lot of news that small cap funds may be entering frothy territory, and this is signaled by mutual fund houses actually curtailing inflows on small cap funds. Many of them have stopped taking lump sums, or some even have restriction on even the SIP amount that you can invest in. So, this high inflows and rally in small cap funds has prompted this advice. So, should you take that advice? If you are investing in small cap funds, should you stop investing? Or should you, if you haven't invested and you plan to invest, should you invest at all? Now, to understand this, first let's get into what is triggering this conversation now. In the past month, if you see this data that we have here, small cap funds have received significant inflows. In fact, as much twice as much as large cap funds. And if you see on a net basis, large cap funds have seen outflows, and it is perceived that this money has actually got into small cap category because the returns are much higher now in the small cap category. A year ago, it was a very different story. The returns are much higher now. And therefore, this has prompted many fund houses, effective June end or July, to stop taking fresh lump sum inflows. They want to have planned inflows in the form of SIPs. Now, what are the concerns that the market has when there is advice floating that you should not invest in small cap funds at this point? The first concern is that of the growth prospects of small cap stocks, which is where small cap funds invest in, and also the premium valuations that many of these small cap stocks may have gotten into. Now, just to understand this, let us look at the index itself, the small cap 250 index. There are two indices, small cap 100 and small cap 250. 250 is a larger universe. And if you look at the returns since last April of 2022, you will see that this is rolling 1 year return, right? So this 1 year returns tells us that it started underperforming the Nifty at around July 2022, and since then it's largely been underperforming, and only from beginning of end of May or so, that the small cap 250 index has really taken off in terms of performance. In other words, in the past 1 year, it has been underperforming, unlike the Nifty, which is already performing, and it continues to. So the in other words, small cap index is just taking off. In the past 2 months at least, you have started seeing a rally. The other thing is the valuation. Now, this data point is important. You will see from very high valuation in Jan 2022 at around 32 times, the small cap index significantly fell. And over this period, you can see that the returns, the index itself, the blue line is the index itself has been moving sideways, not necessarily upwards, but not too much of a fall. After July 22, it hasn't seen too much of a fall. It has been steady, but the price earnings ratio has been going down gently. How could this happen? I mean, when the index is kind of sideways to up and the PE is going down, it means that earnings has expanded, right? And earnings did expand, and earning continues to expand in double digits. So if you take the small cap index, 100 Nifty 100 small cap index, earnings have been in the range of 16 to 18% for the full year ending March 23, right? The previous year also saw, on a trailing basis, significantly high growth on earnings. So an earnings expansion without an equal, if not more, expansion in the index has caused the index to compress, and that has reached a point around April, where it's kind of hit a bottom, and there is, because of the sharp rally that we started seeing since, you can see that the P is at around 21 times or so now, still significantly lower than what we saw in Jan 22. And from Jan 22, we have seen a fall. So this is something that we should realize. We are not at a kind of a point where the valuations are at a peak, or the rally has been long, etc. No, it's just started rallying if you compare it with the Nifty. So that's very important when you understand the prospects for the small cap category. The second point is a concern over liquidity. Now, this is a very fair concern because in India, the small cap stocks, first of all, Those that are reasonably traded are not large in number. Their market cap is also not very high, but what we need to understand is that they have been growing in the past few years. Just to give you an example, SEBI's definition, of the small cap stocks is a range between 0 to 16,800 crore as of now. 16,800 crore is a very large size for market cap compared with say 5,000 or 6,000 crore that we had 7 8 years ago. That was a max for to be classified as a small cap stock. So the size of these stocks, what we call small cap, has been growing, and it is natural that it grows along with the market, right? As the market grows, obviously the market cap of even the small cap segment grows, because your largest stock has a very high market cap. Naturally your small caps too tend to grow further. So the Nifty Small Cap 250 itself has, an average market cap, if you take these 250 stocks, of close to 11,000 crore. Oh, that's significant, right? Um, so this SEBI's definition is a maximum of 16,800, and the average is around at 11,000 crore. So that basically means they're not very tiny companies to begin with. That's a point that I'm trying to make here. And if you take, the total market cap of the small cap 250, that's around 26.9 lakh crore. This is as of, beginning of July as we do this video. And of this, let's take the non-promoter holding, because, the promoter holding obviously will not have any trading in the market. So about 45% is non-promoter holding. That means those shares are available for trading, right? That comes to about 12.2 lakh crore. Now let's take how much mutual funds have in small cap funds. That's 1.65 lakh crore, or in other words 13 to 14% of this total tradable, you know market cap of small caps is all that mutual funds hold, right? And in this, please remember, small cap funds are allowed to hold up to 35% in other market cap segments, that is large, mid, or even in debt. And small cap funds have actually been holding close to 30% in either in a combination of large, mid cap, and also debt. In fact, quite a few funds have, some of the large funds have quite a bit in large cap stocks to ensure that they have liquidity. That is, they are able to sell whenever they want to. If they have to meet your redemption, etc., they'll have enough liquidity. So that's a very, very important point that we need to keep in mind, that small caps don't invest 100% of their, assets in small cap stocks. Small cap funds need to invest at least 65%, and at this point it's around 75%, which means that 30% are much larger stocks or liquid debt instruments that they hold. That means your liquidity is reasonably taken care of. So that's something that you need to understand. Yeah. So um, then why is it that mutual funds have stopped, accepting lump sums? Are they not able to deploy, or they believe that the market is at a peak and deploying now might, they might suffer a crash, etc.? I don't think so. AMCs have been curtailing inflows even in normal times. Many large funds like SBI, small cap, etc., have not been accepting lump sums for a good while now. There are windows where they open, but they basically close, and even the SIP amounts are restricted because they like the certainty of these inflows. Why is it so? Because with small cap stocks, entry price becomes very crucial, right? You cannot go on buying a stock at higher price level, like you possibly can afford to sometimes in large caps, but you cannot afford it. So they will have to deploy fresh money in newer opportunities, right? So they have to be, they cannot go on buying the same stock. All right, a fund manager may be able to add Infosys, but you may not be able to add some, small cap, say like Atega Industries, at any point. You can't go on adding them. So that's another reason. So price at entry point is crucial, and to that extent, they do not want excessive inflows. Um, they're having a planned strategy, right? But what else is that, what is the pain point for a fund manager? The primary pain point is that if there is a market crash, not in normal times, if there is a market crash, the liquidity can dry up all of a sudden, as in you may not be able to easily sell your holdings. Now, that is always the biggest concern for any fund manager. And they may be forced to sell it at prices that are not at market price but at a discount to market price. So, what happens? I may be sitting on a book profits of say 50%, 60% gain, but when I sell it in a bad market, I may be forced to sell at lower price. So the actual profit I see on paper may not be the cash profit that I get. I may be selling at lower price because I want to dispose of that stock. When things are bad, you ask for money, you want to redeem, etc. Right? Let's just understand this liquidity risk. I've taken an example here from just for illustrative purpose. This is not a recommendation on any fund, from HDFC small cap. It holds this stock in small quantity. Just 0.6% is held in advanced enzyme technologies. And I have mentioned here the number of shares and also the daily average, both exchanges combined volume, right? The liquidity in days is nothing but the total number of shares that HDFC small cap holds divided by the daily volume at any point in time in the market on an average. So to entirely dispose of its 42 lakh shares, which is what it holds, it needs about 11 days for this particular stock alone, right? That basically means this is not a terrible stock, but it's not super liquid. I can't dispose it in one day like I would do with Infosys or HDFC. If I held 42 lakh shares of, say, TCS or Infosys or HUL, I'd be able to easily dispose it off in a day. But I can't do this here. One, they may not be takers. Two, I might take a price hit by trying to do so, right? And they call it impact costs and all that. So to avoid this, they have to slowly, kind of. So the average time it might take, it might be much shorter. But if this is the daily volume and this is the total number of shares I hold, I will take about. In reality, they possibly can't entirely sell based on the daily volume. They will sell even lesser quantity, and that will make your days even more, the liquidity days even more. This is the only and the very large looming risk for fund managers in a falling market, right? That does not mean that when they stop taking lump sums from you, they are expecting this to happen. When they stop taking lump sums from you, it basically means that they don't want to be deploying more and more when they are clear that a rally has taken off. So, to this extent, they are only looking for newer opportunities, so they can't afford to have too much money. They want to have a planned inflow, which is possible only through SIPs. So, this is primarily the reason. So, what should you be doing about investing in these? See, small cap funds are meant for long term investments, and in the long term, small caps have delivered, and in fact, small cap active funds have beaten the small cap index significantly. What I've shown you here as returns is the index, but funds have delivered a lot more. So, if this be the case, and this remember, despite them going through the roughs in these 5 years, if you look at the 5 year returns, they have had multiple periods of falls, especially the last 2 years have hardly delivered. The last 1 year had been quite tough on the small cap segment, and in spite of it, they have beaten the Nifty. So there is no reason that you should hold back investments in small cap funds if you are looking at a long term portfolio, right? The only thing is you never hold, whether it's a good market or a bad market, you never hold a large sum in small cap stocks. Small cap and mid cap overall, these funds cannot account for more than 15 to 30% of your portfolio put together, I mean, and even that only in a long term portfolio if you have moderate to high risk, not for low risk investors, because of the sheer volatility of this market cap segment. And in general, because you're investing for the long term, it makes sense to use SIPs to deploy. But in market falls, if funds open up, it makes sense to put some amount as lump sum, right? So the next 3 or 4 months SIPs can be put ahead as lump sum. So this should be your strategy with small caps. The key is to keep your exposure low, right? And small caps can deliver, alpha to your portfolio, provided you are prudent. They can also hit your portfolio. So this is the only concern. Do not worry about what fund managers will do to find opportunities. Like I told you, it's not like small caps have been rallying for very long and the market size has grown. More newer companies have come. There are opportunities. It's just that fund managers are being prudent in terms of deployment. So that's the key thing that you need to know.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.